Welcome to the MUFG Global Markets Podcast. I'm John Cook, and I'm joined today by Takahiro Sekido, Chief Japan Strategist for MUFG. It's Monday, November 29th, 2021. Welcome back to the podcast, Sekido-san.
Good to be back.
Always good to have you. So I think at this point, we'd be remiss without discussing the Omicron variant, as that is literally all that matters to market participants locally. So I guess the question is, how has Omicron affected markets in Japan?
Okay. The Nikkei average and Dong Yen tumbled on the news about the emergence of new COVID variant, Omicron, last week. But the yen swap rates and a yen basis remained flat. The front end of the yen basis curve tightened. The Nikkei average consecutively plunged nearly 2% Monday. There's still a sense of fear about the Omicron variant. On the other hand, surprisingly, U.S. stock futures have shown a sign of a turnaround during the Asian trading hours, while the decline of the yen's rates has been limited. Dong Yen downside has been contained. Japanese investors' strong appetite for foreign investment is clear. Whether the uncertainty about Omicron will be cleared up is unknown. However, Japanese investors out of investing has been creating yen cross-currency arbitrage opportunities, especially for yen basis. So far in the second half of fiscal year 21, Japanese are awash with funds and have many direct investment projects in the pipeline. And these will lead to arbitrage opportunities around the world.
Yeah, that makes a lot of sense to me. I mean, if you just look at 3-month dollar yen basis, it always widens out around the turn, and then usually it kind of tightens back in. And this year's been very odd in that it widened out around the turn and sort of leaked wider ever since. And just generally even moving a little bit further out the curve, the basis sort of seems kind of range bound. Doesn't seem to be a lot of evidence of it materially tightening. So let's switch topics here. Let's switch topics here for a second. There's been a ton of headlines really on both sides of the Pacific about government stimulus. Specifically in Japan, there's a supplementary budget of about 32 trillion yen. I've been getting a number of questions from clients about how this is going to affect JGB issuance. So why don't you take us through the numbers and the implications?
Okay. The Ministry of Finance on November 26 released its JGB issuance plans to cover the government's fiscal year 21 supplementary budget. There is mostly no change for JGB issuances. By legal basis, the Ministry of Finance will cut issuances of the Philip bonds by 30 trillion yen versus the initial budget, cut refinancing JGBs by 3.5 trillion yen, and increase regular JGBs by 22 trillion yen. In fact, 6-month TTB issuances will shrink by 9 trillion yen and a non-price competitive auction 2 JGBs by 1 trillion yen, while JGBs for households will be cut by 1 trillion yen. We have changed our view of the bias for yen swap rates to neutral from upward bias last week, based on the media speculative reports. But given that the Ministry of Finance will put off increasing the issuances of JGBs, we think the bias will stay neutral, despite hype about the huge size of the additional economic measures. New JGB issuance for fiscal year 21 will be limited. Speculation about an increase in the JGBs in fiscal year 22 may build again in December. However, the government now has a glut of surplus yen funds at the BOJ, 36 trillion yen as of November 20th. In fiscal year 21, the MOF has been cutting issuances with 6-month TTBs, and has now also decided to cut new issuances with 6-month TTBs. We recommend that overseas investors trade TTB asset swaps as soon as possible. The BOJ will change JGB purchases depending on foreigners' JGB arbitrages, and the front end of the JGB yield curve could stay low and stable. Investors will be noting the MOF's stance toward the extending of JGB duration in a fiscal year 22 JGB issuance plans. Room for downside appear to be limited for the long end of the JGB yield curve.
Wow, that's really interesting. Okay, so despite all these huge numbers that are getting thrown around, a supplementary budget of 32 trillion yen and 22 trillion yen of new JGB issuance, the truth is really that the Ministry of Finance is just moving around JGB issuance, and there's such a large cash balance that the need to increase JGB issuance going forward is actually pretty limited. I think that's something that I think that those are some facts that are lost on a number of investors. So thanks so much for taking us through that.
Thank you.
And then, one topic that we didn't get to a chance to discuss in last week's episode was the TIC data for September. As you know, this is like one of my favorite things to talk about. As always, I'm curious, what that, along with the Ministry of Finance balance of payments data, tells us about what Japanese investors were doing in foreign bond markets at the end of the fiscal half year. So please tell us.
Okay. U.S. Treasury International Capital TIC data for September, released on November 16th, showed that Japanese net worth $7.8 billion of treasuries, $9.7 billion of agency MBS, and $728 billion of U.S. corporate bonds. September U.S. TIC and Japanese balance of payments shows that Japanese investors holding U.S. bonds were fairly large nearing the end of the quarter. Despite differences in the U.S. and the Japanese data in August, this appears to be due to a time lag when the September data was posted. At the same time, Japanese investors bought not only treasuries, but also the agency MBS and U.S. corporate bonds, and their whole building of U.S. dollar bond positions was impressive. Japanese expanded their dollar bond positions, firstly on the eve of Fed tapering, and secondly, based on end quarter conditions. Japanese investors net bought 4.6 trillion yen of medium to long-term bonds in September, including 3.8 trillion yen of U.S. medium to long-term bonds. Of the net buying of medium to long-term bonds in September, 2.7 trillion yen was by banks. 1.2 trillion yen was by trust banks pension funds. And 238 billion yen was by lifers. Japanese banks and pension funds showed greater preference for U.S. bonds than for other G10 bonds at end September, when New York markets were calm.
Yeah, interesting to have Japan, ramp up purchases into the taper. But as you highlight, it does make sense, for Japan to try and get invested at the end of the fiscal half year. I'd also note that I saw in the data and previous conversations with you, there's a pickup in purchases into the Eurozone and some pretty good sales of Australian bonds as well as gilts, which proved well timed in retrospect, given some carnage in those markets, in what I believe it was early November. So I think we're probably looking to wrap it up here. So, but we would be remiss in not getting your outlook on yen rate, spot dollar yen, and yen basis before we do. So please take us through it.
Dollar rallied briefly against the yen on the news of the Fed. Chair Powell will be renominated before the news about the new COVID variant Omicron broke. Dollar yen 115 looks far off for now, but the real threat from Omicron has proven the firmness of the lower bound for dollar yen. We expect the uncertainties related to Omicron to steer volatility for dollar yen. We now expect dollar yen to trade in a wider 3 yen range between 112 to 115 with a neutral bias. Yen rates have taken a neutral bias again. The front end of the yen basis curve was widened before the Omicron news caused it to tighten again. The Ministry of Finance weekly securities flow data shows Japanese investors loaded a net 535 billion yen of foreign securities in the week of November 14th to 20th, as the pace of selling accelerated. Net selling of foreign stocks and investment fund holdings by 545 billion yen drove the trend. Japanese turned net unloader of foreign medium to long-term bonds by 12 billion yen. Foreigners net bought 3.5 trillion yen Japanese securities. Yen cross-currency investing flows among foreigners picked up further. Japanese net bought short-term bonds by 2.5 trillion yen and medium to long-term bonds by 1 trillion yen and turned net sellers of Japanese stocks and investment fund holdings for the first time in 7 weeks by 47 billion yen. Preference for JGBs appeared to have grown among foreigners because of risk related to the new Omicron variant. We expect foreigners flows to dominate on the front end of the JGB curve, and for the yen basis curve to change from a widening to a neutral bias.
Awesome. Thanks for taking us through that, and really great stuff again today. And thanks again for joining us, Sekido-san.
Thanks for having me, John.
And thank you for listening to the MUFG Global Markets Podcast. Rate, review, and subscribe on Apple, Spotify, or wherever you get your podcasts. And reach out to your MUFG sales rep for any further information. Check back soon for more insights from the Global Markets Research Team.